Product Control, Fixed Income Desk Interview Preparation In-Depth Guide. If you are preparing for product control roles on a fixed income, rates, credit, or FX trading desk in an investment bank, this video is made for you. We have created very comprehensive interview preparation material, specially designed for investment banking fixed income desks, not generic finance explanations. In this session, we go deep into how product control actually works across rates, credit, FX, and structured fixed income products. You will learn how interviewers expect you to explain daily P&L, yield curves, discounting, DV01 and CS01, credit curves, valuation adjustments like CVA and FVA, and real-world reconciliation challenges. Every question in this video mirrors actual investment bank interviews, explained in a clear, step-by-step manner, so you understand the logic, not just the answer. Do watch this video till the end. Explain the core responsibilities of a product controller on a fixed income trading desk and how they differ from those on an equities desk. A product controller on a fixed income desk acts as the guardian of valuation integrity, daily P&L accuracy, and balance sheet correctness. The role is similar to equities, but the mechanics are different because fixed income relies heavily on curves, spreads, credit risk, and discounting. Your main responsibilities include daily P&L production and explanation, independent valuation and curve verification, ensuring correct booking of trades, swaps, bonds, futures, FX swaps, and credit derivatives, monitoring risk metrics such as DV01 and CS01, applying valuation adjustments like CVA, DVA, and funding adjustments. The difference versus an equities desk is simple. Fixed income depends more on term structures, yield curves, credit curves, discount factors, and interest rate dynamics. Equity desks focus more on volatility surfaces and option Greeks. Fixed income product control is more curve-driven and more sensitive to tiny movements. Walk me through the daily P&L process for a fixed income desk handling rates, credit, and FX products. Start with the building blocks. You collect positions and trades from booking systems, market data, yield curves, credit spreads, swap curves, and FX forwards. Risk sensitivities, DV01, CS01, cross-currency deltas, and convexity. Model valuations, including OIS discounting where relevant. Next, you validate the data. You check for curve shifts that look abnormal, stale prices, or missing points on credit curves. Then you compute P&L. Realized P&L from trades that closed or coupon cash flows. Unrealized P&L from revaluing all open positions. Funding and discounting effects from curve changes. Credit spread moves. FX impact for cross-currency products. Finally, you report. You break the P&L into curve shifts, spread movements, carry, roll down, new deal impact, and adjustments. Your job is to make the numbers understandable and defensible. That. A trader disputes the P&L by claiming your interest rate curve is incorrect. How do you validate and reconcile this? You begin with calm discipline. First, compare your curve to market sources, swap quotes, treasury yields, futures prices, or broker runs. If your input differs from market levels, investigate why. Second, verify construction logic. Check how the curve was bootstrapped. Confirm the instruments, interpolation method, and calibration settings. Third, run a parallel valuation using the trader's curve. Compare the P&L difference. If their curve improves market fit, you may adjust the official curve. Finally, document the findings. Consistency, transparency, and evidence decide the outcome, not negotiation. Explain how yield curves, discount factors, and zero coupon curves impact valuation for fixed income products. Every fixed income valuation depends on discounting, turning future cash flows into today's value. Yield curves show market interest rates across maturities. Zero coupon curves strip those yields into pure zero rates. Discount factors convert a future payment into present value using those zero rates. A simple example, a 1-year discount factor of 0.98 means a $100 payment is worth $98 today. Swaps, bonds, and credit products derive value by applying these discount factors to every cash flow. So a small curve shift, even 1 basis point, changes valuations meaningfully. Describe how DV01, CS01, duration and convexity contribute to P&L analysis for a bond or interest rate swap book. These metrics explain how sensitive the book is to rate or credit movements. DV01 shows the change in value from a 1 basis point shift in interest rates. If DV01 is $10,000, a 1 basis point move creates about $10,000 of P&L. CS01 shows sensitivity to credit spread changes. If spreads widen, bond values fall. Duration measures first-order rate sensitivity, similar to DV01 but scaled for bonds. Convexity captures second-order effects. When rates move a lot, convexity becomes significant. Daily P&L becomes the sum of these effects, plus any model changes or booking movements. A sudden parallel shift in the yield curve creates unexpected P&L. Explain how you would attribute and break this down. Start by measuring the size of the curve shift. Was it 5 basis points? 10? More? Then apply the desk's DV01 for each maturity bucket. Multiply DV01 by the curve movement to estimate expected P&L. Next, examine convexity. Large moves create curvature effects beyond simple DV01. Then check. Position changes, missing hedges, incorrect curve buckets, FX translation effects for cross-currency swaps. Finally, summarize the explanation by driver. For example, 30,000 from the 2-year bucket, 20,000 from the 10-year bucket, negative 15,000 from convexity. What controls do you perform to independently verify marks for illiquid corporate bonds or structured credit instruments? You use triangulation, multiple evidence sources. You compare trader marks to broker quotes, trace prints, similar bonds from the same issuer, scepter curves, historical spread relationships, expected recovery values. For structured credit, you check tranche correlations, default assumptions, and expected loss models. If marks fall outside observable ranges, you challenge them and apply valuation reserves. Explain the concept of independent price verification (IPV) for fixed income products and how you determine IPV reserves. IPV ensures the desk's prices reflect market reality. You obtain external data, quotes, curves, spreads, and trade prints. You compare these with trader marks. If differences exceed tolerance ranges, you adjust the marks and record the deviation. IPV reserves are based on the uncertainty of inputs. Illiquid bonds, long-dated swaps, and synthetic credit often require reserves. The reserve magnitude reflects spread volatility, data reliability, and model uncertainty. Walk me through how you validate credit curves used in pricing CDS, indices, and credit-linked notes. You begin by checking the bootstrapping process. The curve must reproduce market CDS spreads at each maturity. Then verify the hazard rates implied by the curve. These should be smooth, positive, and economically reasonable. Next, compare curves with index levels, peer names, benchmark spreads, historical ranges. Finally, test valuation impact. Shift the credit curve up or down and check that P&L sensitivity, CS01, behaves as expected. A bond is trading thinly with unreliable prices. How do you determine a fair value and justify it to audit or regulators? You gather multiple evidence sources. First, look at comparable bonds, same issuer, similar maturity, similar coupon. Second, review sector and rating curves. Third, check any available trades, even if stale, and adjust for market moves. Then, build a model implied price using spread relationships, OAS models, or discounted cash flow. Document every assumption. Your justification must show prudence and consistency. The regulator is looking for process, not perfection. Explain how funding spreads and liquidity premiums affect valuation and P&L of fixed income instruments. Funding spreads represent the bank's cost of financing the position. Liquidity premiums compensate for the difficulty of exiting a position. When funding spreads rise, discounted values fall, producing negative P&L. When liquidity premiums widen, the fair value of illiquid bonds declines. A simple example: if funding cost increases from 50 basis points to 60, the swap valuation decreases because future cash flows are discounted more heavily. Product control ensures these effects are recognized fairly. Describe how to calculate and justify valuation adjustments such as CVA, DVA, FVA, and OIS discounting. CVA, credit valuation adjustment, reflects counterparty default risk. It depends on expected exposure, default probability, and recovery rate. DVA is the bank's own credit adjustment. FVA captures the funding cost of hedging the position over time. OIS discounting uses overnight index swap curves for collateralized trades. You compute these using exposure profiles generated by simulation or deterministic methods. You justify them with market credit spreads, funding curves, and regulatory policies. A counterparty credit downgrade occurs. Explain its immediate and indirect impacts on P&L for a derivatives book. Immediately, a downgrade increases the counterparty's default probability. This increases CVA, lowering the value of positive exposures, so P&L becomes negative. Indirect impacts include collateral terms may tighten, funding spreads may widen, some hedges may become more expensive. The effect can last for weeks as credit markets reprice the counterparty. End. How do you attribute P&L for an interest rate swap across risk factors such as curve shifts, roll down, carry, and convexity? Break the P&L into components. Curve shifts. Multiply DV01 by the curve move in each bucket. Roll down. This is the natural change as the swap ages. As you move one day forward, the trade slides down the curve, creating a valuation effect. Carry. This reflects coupon payments and accrual impacts. Convexity. Second-order rate effects that appear when moves are large. Attribute each driver explicitly. And verify that the sum equals the total P&L. A trade is booked with incorrect notional or coupon. Explain how this flows through risk, valuation, and P&L. A wrong notional creates immediate risk distortions. DV01 and CS01 will be overstated or understated. A wrong coupon affects all future cash flows. Valuation becomes incorrect. As a result, P&L becomes misleading because unrealized P&L depends on correct cash flows and discount factors. You correct the booking, reverse erroneous P&L, and rerun valuations. All right. That is enough. Describe how bond amortization, accretion, and coupon accruals affect daily P&L. Coupon accrual increases value daily until the next payment. This is positive carry. Amortization reduces principal over time, common in mortgage-backed structures. Accretion increases the value of discount bonds as they approach par. These components affect P&L even if the market does not move. You show them separately to distinguish market effects from accounting effects. Explain the difference between clean P&L, dirty P&L, and economic P&L on a fixed income desk. Clean P&L excludes new trades, reserves, and funding effects. It reflects pure risk-based movements. Dirty P&L includes everything: new deals, accruals, adjustments, and reserves. Economic P&L shows long-term profitability. It may defer day-one gains or distribute adjustments over time. These three views help management understand signal versus noise. How do you validate inputs like recovery rates, hazard rates, or credit spreads used in pricing credit derivatives? Start with market data, published recovery assumptions, default studies, CDS spreads, bond implied spreads. Hazard rates must be positive and consistent across maturities. Run sensitivity tests. If changing recovery from 40 to 30% shifts valuation drastically, you document the risk. If trader inputs deviate from market standards, you challenge and propose reserves. You observe unusual negative P&L from FX swaps on the cross-currency book. How do you diagnose the root cause? Check the basics first. Was the FX forward curve updated correctly? Did spot FX move materially? Were interest rate curves for both currencies correct? Was a leg of the swap misbooked? Next, analyze carry and basis. Cross-currency swaps depend on basis spreads. If basis widened, valuations fall. Finally, test settlement cash flows. Incorrect settlement dates or mismatched cash flows often create noise. Walk me through how product control reconciles front office risk sensitivities, DV01, CS01, with finance calculated risk. You begin by extracting the desk's official risk metrics from the front office system. Then, you calculate the same sensitivities independently using finance valuation tools. If differences exist, compare curve construction, sensitivity bump sizes, model versions, netting of positions, missing trades. You reconcile line by line until risks match within tolerance. This alignment is essential for accurate P&L explain. Describe the checks you perform to ensure correct modeling of callable, puttable, and mortgage-backed securities. For callable and puttable bonds, the key risk comes from the embedded option. So your checks focus on whether the model captures early exercise behavior correctly. You confirm the correct option type, call, put, or both. The correct schedule, dates, notice periods, barriers. The correct interest rate model, often a tree or lattice for path-dependent behavior. That Greeks behave smoothly around exercise boundaries. For mortgage-backed securities, MBS, you validate prepayment models. MBS cash flows depend on homeowner prepayment behavior, which changes with interest rates. You check prepayment assumptions, seasoning effects, sensitivity to rate moves, benchmark comparisons with agency models. If numbers behave erratically, you escalate. Model control for these products must be tight, because tiny assumption changes create big valuation swings. How do you validate the prepayment model assumptions used in mortgage-backed or asset-backed securities? You begin by understanding which prepayment model is used. For example, a public securities association curve or a proprietary model. You then compare its assumptions to market norms. How sensitive is prepayment speed to interest rate changes? Does the model reflect burnout, seasonality, and refinancing incentives? Are speeds consistent with historical experience? Next, run stress tests. Increase or decrease prepayment rates and observe valuation impact. If the valuation changes too sharply, assumptions may be unstable. Finally, compare outputs to agency benchmarks or observed speeds in similar pools. Your role is to ensure prepayment assumptions are reasonable, documented, and independently validated. End of sentence. Explain how curve inversion affects pricing and P&L on interest rate swaps and government bonds. A curve inversion occurs when short-term rates exceed long-term rates. This changes the economics of swaps and bonds. For swaps, the fixed leg may become more or less valuable depending on where the inversion occurs. Short-dated payments get discounted at higher rates than long-dated ones. This often creates non-intuitive P&L. For bonds, duration and convexity behave differently under inversion. Short maturities may fall more in value, while longer maturities may stabilize. P&L attribution must isolate. Shift in short end, shift in long end, changes in slope, convexity effects. In an inverted environment, carry and roll down may turn negative, even if markets do not move. Describe a case where carry and roll down explain most of a bond's P&L. Walk through the calculation. Carry is the value gained from accrued coupon income. Roll down is the change in bond price as it rolls down the yield curve over time. Imagine a 5-year bond yielding 4%, with a positive yield curve slope. As 1 day passes, the bond becomes a 4 years and 364 days bond. It now sits at a lower yield point. Lower yield means higher price. That's roll down. If markets are quiet, these two effects, coupon accrual and roll down, may explain nearly all the day's P&L. When explaining, you show carry equals daily accrual, roll down equals price change from sliding down the curve, total equals observed P&L with minimal market contribution. You discover large unexplained P&L, UEP, in a credit derivatives portfolio. What steps do you take to isolate the source? First, break the portfolio into components: single name CDS, indices, tranches, and credit-linked notes. Then compare yesterday's credit curves versus today's trader marks versus independent marks, risk sensitivities, CS01, jump to default, notional changes and trade feeds. Next, revalue one product at a time to isolate where the noise originates. Often, the cause is either a stale spread, misapplied recovery rate, or incorrect curve point. If UEP remains material, escalate to valuation control and risk. Document every step before sign-off. How do you construct and validate a liquidity reserve for structured credit or distressed debt positions? You start by evaluating market depth. If trades occur infrequently, liquidity risk is high. Then examine bid-ask spreads. Wide spreads imply higher uncertainty, requiring larger reserves. Next, review historical volatility of spreads. The more unstable the spread, the bigger the cushion required. For structured credit, assess tranche thickness, correlation uncertainty, model sensitivity, dependence on unobservable inputs. Document rationale and review with risk committees. Liquidity reserves must be conservative yet defensible. End. Explain how macro events, rate hikes, credit spread widening, central bank announcements feed into fixed income P&L. Rate hikes shift the entire yield curve upward, creating losses for fixed-rate assets due to higher discount rates. Credit spread widening reduces the value of corporate bonds and CDS protection sellers. This explains negative P&L for credit books. Central bank announcements often change forward rate expectations, volatility, term premia, currency valuations, product control attributes each P&L move to the underlying market driver. Rate move, spread move, FX move, or volatility move. A model change leads to a significant day one P&L impact. How do you determine what portion is deferrable under accounting rules? First, identify why the model changed. Is the improvement structural? Was the old model flawed? Does the new model rely on unobservable inputs? If new inputs are not directly observable in markets, such as long-dated volatility, correlation, or hazard rate assumptions, The day one P&L resulting from those inputs is often deferred. You determine the deferrable portion by quantifying valuation impact from unobservable parameters, reviewing model validation documentation, applying firm policy for day one P&L deferral. Only the portion supported by observable market data is recognized immediately. End. Describe how to challenge a trader's marks using comparable bonds, trace data, or broker quotes. Start by collecting objective data. Trace prints, recent actual trades, broker runs, indicative quotes, comparable securities, same issuer or rating, sector curves, AA, single A, triple B, spread relationships, OAS comparisons. Now compare trader marks. If the trader marks a bond at 103, but peers trade around 98, challenge the deviation. Provide a structured case. Here is the comparable bond. Here is the latest trace print. Here is the broker quote. Here is the implied spread. Your strength comes from evidence, not confrontation. You detect unusual risk movements inconsistent with trading activity. Walk me through your investigation steps. Start with the basics. Verify whether a trade was booked late, modified, or canceled. Then check if risk sensitivities recalculated incorrectly due to curve shifts, missing data, or stale market feeds. Next, confirm that positions match across systems: front office, risk, and finance. Run a position delta. Compare yesterday's net notional to today's. If risk changed but notional did not, something is wrong. Finally, trace the issue to booking errors, model issues, or incorrect market data. Document the cause and ensure controls prevent recurrence. Explain how cross-gamma, cross-vega, or multi-factor risk exposures can create complex P&L effects on structured rate products. Structured rate derivatives often depend on multiple curves and multiple risk drivers. Cross-gamma measures how sensitivity to one curve changes as another curve moves. Cross-vega measures how sensitivity to one volatility point changes when another volatility moves. For example, a callable swap depends on both interest rate volatility and the shape of the yield curve. If both shift simultaneously, P&L effects interact, not simply add. You use multi-factor attributions to break P&L into single-factor effects, cross-factor effects, model effects. Clear explanation prevents confusion on volatile days. How do you verify collateral discounting curves used in OIS-based valuation frameworks? You start by ensuring the OIS curve reflects real collateral rates, typically overnight indexed swaps. Check. Curve construction methodology, day count conventions, bootstrapping inputs, deposit rates, futures, and OIS swap quotes. Interpolation methods. Compare your OIS curve to market references. Run valuation tests on standard swaps. Par swaps should price at zero. If OIS curves differ materially from trader curves, challenge assumptions and adjust. The end. Describe the process for reviewing P&L for long-dated swaps or exotic IR derivatives, where small curve moves cause large valuation swings. Long-dated swaps have high duration and high convexity. Tiny curve shifts, even 1 basis point, may create large P&L. So you verify curve integrity carefully. Ensure correct notional and maturity details. Check for model changes. Review convexity adjustments. Rerun sensitivities to confirm DV01 and convexity values make sense. For exotic products like Bermudan swaptions, test whether the model behaves stably under market moves. Then explain P&L using both first-order and second-order effects. How do settlement delays or mismatched cash flows create accounting P&L noise on a fixed income desk? If cash flows settle late, the ledger may show expected cash flows that did not actually occur. This creates temporary P&L mismatches. Mismatched cash flows, for example, wrong coupon amounts or dates, create artificial gains or losses. Product control detects these by reconciling coupon schedules, accruals, settlement notices, cash movements. Once corrected, accounting P&L realigns with economic P&L. Explain how to validate forward rate agreements, FRAs, and futures-based interest rate hedges. For FRAs, confirm start and end dates, notional, fixed rate, correct curve used to project forward rates. Check FRA valuations against implied rates from the yield curve. For futures-based hedges, validate conversion from futures price to implied yield. Ensure correct contract size, margining, and expiry alignment. Confirm that hedge ratios are consistent with underlying risk. If DV01 of the hedge differs from the exposure, P&L will not hedge cleanly. A desk launches a new structured fixed income note. What front-to-back controls and validation steps must product control implement? This requires full new product approval. You validate payoff structure and documentation, model suitability, curve and spread inputs, booking templates, system readiness for coupon schedules and cash flows, accounting treatment, risk sensitivities, DV01, spread risk, FX risk, required valuation adjustments. You perform dry run tests before the first booking. Only after all teams sign off, valuation control, risk, legal, finance, can the product go live. End. How do you prepare senior management P&L? Explain for a volatile credit trading day with multiple risk factor drivers. You focus on clarity, hierarchy, and cause-effect. Start with the headline. Desk lost $30 million due to broad credit spread widening. Then break it down. Spread widening by rating buckets, specific issuers, index versus single name exposures, curve shape changes, jump to default movements, hedge performance. Add context. For example, spread widening followed a macro announcement. Liquidity dried up. Broker quotes became sparse. Finish with key follow-up actions and risk implications. A trader claims that widening credit spreads should have resulted in a profit, not a loss. How do you walk them through attribution to prove otherwise? You isolate exposures first. Ask, are we net long credit risk or net short? If the desk holds protection sold, widening spreads mean losses. If they hold protection bought, widening spreads mean gains. Next, show the CS01 sign. Positive CS01 means value falls when spreads widen, hence a loss. Then walk them through component P&L. Curve shift impact, index versus single name behavior, basis changes, residual hedges that may have moved oppositely. Using numbers and sensitivities removes ambiguity. Space. Describe how stress testing and VAR results influence product control's P&L review and reserve setting decisions. If stress tests show large losses under specific scenarios, for example, a 50 basis point spread widening, product control evaluates whether reserves should reflect this tail risk. If VAR rises sharply, it may indicate unstable positions or model sensitivities. You review whether P&L explain remains reliable. Stress results also help determine if current valuation adjustments, liquidity, credit, or model reserves remain adequate. Thus, stress testing influences risk conversations, capital allocation, and reserve policies. Give an example where you identified a valuation or booking issue on a fixed income desk, how you escalated it, and what the final resolution was. Here is a simple hypothetical. A trader booked a 5-year swap with notional of $100 million instead of $10 million. Risk jumped 10 times overnight. DV01 grew massively. You notice the mismatch when reconciling risk sensitivities. You checked the trade ticket and identified the incorrect notional. You escalated to the desk head, operations and valuation control. The trade was corrected, erroneous P&L reversed, and controls updated to require secondary review for large notionals. This example shows the core of product control: independence, accuracy, and escalation discipline. Fixed income product control is not about watching rates move. It's about understanding why every basis point matters. This was a complete, end-to-end interview preparation session built specifically for fixed income roles in investment banks, covering rates, credit, FX, curves, and valuation control in depth. If you followed this entire video, you now know how interviewers think, how to explain curve-driven P&L, and how to defend valuations with confidence and evidence. Rewatch key sections, pause, and practice explaining them aloud, because structured thinking and clarity are what interviewers reward. For more deep, role-specific interview preparation for investment banking, stay connected. And once again, do watch, revise, and master this material.